Talk a little bit about how the behavioral, piece shows up at Driehaus and how you guys approach macro.
Yeah, sure. So I think you touched upon this, but with behavioral sort of a behavioral approach, yeah, there is a belief that markets are living organisms, as you kind of alluded to. And the way I always describe it simplistically is that headlines and sound bites and research reports, for lack of a better word, can be sort of cheap, where you're not necessarily having to deposit your own funds, which is far different from the market, where in order to make an impact, you actually have to open the wallet and invest capital. I mean, that's the only way to move stock prices up or down. So I think, well, if you have a very long-term time horizon, it's highly likely that fundamentals and stock prices should correlate. I mean, I'm talking 12 to 20 years plus. The reality, and we've seen this over the past decade, I think, sort of almost magnified, is that stock prices and fundamentals can deviate for certain reasons. I think even going back to 2008 and 2009, we've talked about this before. Had you simply been wise enough to understand what it was the Fed was in fact aiming to do, which essentially, by their own word, their own admission, was to push people down the risk curve. They made it clear to all of us, although we couldn't all see it at the time, that they wanted to basically push people into riskier assets, into longer duration assets. And theoretically, if you had simply interpreted that and allocated all of your capital in that direction and gone on vacation for the next 12 years and come back, whether you were, straight long or had gone long those assets and essentially short the antithesis of that, you would have come back to an amazing gain without having basically lifted a finger in 10 years. So I think there's that. There's also, harken back to like the quotes from somebody like Stan Druckenmiller, who is the investor I respect most in the world, just given his track record and his very logical, straightforward approach. But I think he has always talked about that it's really liquidity that drives markets, and guys like Ray Dalio have touched upon similar characteristics. So I think we look at it that way. I think also going back to sort of observing the market, and I did have a good relationship with someone who worked very closely with Stan, and I may have shared this with you, but in my early years, to be honest, I was a bit apprehensive about kind of disclosing that we used things like technical analysis and behavioral finance, because there was this perception that you needed to have CFAs and MBAs, and that things of this nature were more voodoo. And then I was having dinner with this particular individual, and I was talking to him a bit about sort of technical analysis, and he piped up and said, well, of course, that's all Stan does all day, every day, is just what I was describing, looking for divergences or looking for areas of prioritization where the market is either really rewarding a company or an industry that's delivering, and or in terms of divergences. And this was sort of the case with Russian oil stocks late last year. We kind of asked ourselves, why is the oil price rising? Why are global oil equities rising, and yet Russian equities and Russian oil companies really weren't responding? And the reality is that there's always smarter people in the market than you, and I'm sure smarter people had made a bet or had deciphered whatever was happening in the Russia-Ukraine situation. And so a flag like that can really help from a divergence perspective. But we talk a lot about optimization as well. And so if we have two different companies where we've identified the bottom-up catalysts and triggers, and each, and then related industries or similar business models, and each of those companies is, let's say, achieving the catalysts that we've outlined successfully, we would anticipate a certain performance profile. And if one of those companies is fulfilling those criteria and one of the companies is not fulfilling those criteria, we'll optimize and simply shift into the company where not only do we think we understand the business case, but also we understand why the stock price is moving. And not to keep belaboring this, but it's not something that I was involved with directly. But had we been involved in a situation like Enron, where I think it was like 64 of 65 analysts had a buy rating, and all of Wall Street was hoodwinked, it would have been something similar, where we would have outlined catalysts, and even had we been bullish on the stock, with these kind of persistent, like, hey, they're meeting all their fundamental bogeys, and yet the stock just isn't reacting well, and something's not right. I think at that point, ideally, you optimize and move into a company where maybe you have similar or higher convictions, but also the stock price is reacting. So those are all examples of thinking, I think, there's really well-known biases, and guys like Michael Mauboussin have talked about this, but specifically we focus on anchoring and also recency biases. And what we talk a lot about in our philosophy is identifying second derivative change and earnings inflection points. And so oftentimes, yeah, it's people who are anchored to sort of past views, or trying to incorporate prior data and extrapolate that forward. That works sometimes, but oftentimes, as we know, those trends break. And I think in the last 12 months, we may be amidst a pretty serious regime shift. And a lot of investors and hedge funds, as you and I have talked about, have struggled mightily with that, because the old rules aren't really applying right now. And yeah, the reality is that as much as people may want to exist in a confined laboratory, the market just is not a confined laboratory. And I think it's important to appreciate that.